Hello fellow traders, Marv Eisen here again from Timeless Dollar Trading Academy. And you're looking at my chart, pre-market, the way I set it up, on Thursday, June 5th. And on Thursday, June 5th, there was a very important economic announcement that came out pre-market, and I'm going to show it to you on the U.S. economic calendar, Market Watch. And Thursday, June 5th, you can see it right here, 8:30 a.m., so pre-market, initial jobless claims. Initial jobless claims. Actually, pre-market, the estimate was 236,000 jobs. The actual number was announced at 8:30, 247,000 jobs. So the actual number beat the market. And so we can expect what? Let me tell you something about the economic jobs reports, any initial jobs reports, any ADP jobs reports, any U.S. Labor Department jobs reports. It moves the market. And so the jobs reports always come out pre-market, which is a good thing. But nevertheless, some people, and I'm going to say this because some people trade during market hours that are the electronic market hours, pre-9:30 a.m. when the S&P, when the stock market actually opens. Not a good idea, folks. Not a good idea. And I'm going to show you what happened. And here's my chart, the way I set it up, just prior to 8:30. And I'm going to take you through it. This is a 3-minute candle. Now, let me give you some reference there. 5 points in between each horizontal line on the chart. 5 points, okay? And I drew this based on my Tayor calculator, which I'll talk about a little later. But maybe you should just look at what I'm showing you on my screen and never mind about how I set up my chart, because you probably set up your chart differently. You rely on different indicators. I only rely on three pieces of information. Number one, the stochastics. I always use the stochastics. The previous day's close, which is the equilibrium level. I always put a horizontal line on my chart where the market closed 4 p.m. the previous day, and the Taylor trading zone, which is a mathematical model of where prices are likely to trade. Now, why do I use a mathematical model? Well, because it's the best way, the only way that I know of, to indicate where the market is likely to trade. And it's been proven accurate since George Taylor developed his formulas in the 1950s, 80 years ago, my friends. And so nobody knows where the market, well, this is why I use it. Nobody knows where the market is going to trade. You can listen to any talking head, you can read the news, you can look at economic reports. Nobody knows where the market is going to trade. So I use a mathematical model. Why? It works, okay? So let me take you through the day, and I'm going to show you how the market traded. And remember, I told you that there was a pre-market ADP jobs report that came out Thursday, June 5th. And so let me take you through it as the market moved. And here at 8:30, there's where the report came out, and you'll notice the severe fluctuation, the extreme volatility. All right, again, 5 points between each horizontal line. Let's see, 5, 10, 15, 20, 25, 30, 35. Okay, 35 points between the high and low in a 3-minute candle. These are 3-minute candles. 35 points. Started up down here, went up to 60,016, ended right at 59.95. Now, if you traded this and you made money, great. Chances are this is not the way to trade. If you're going to take these one shots, I don't listen to me, because if this is the kind of trading you do, this is gambling, and I don't suggest you do it. I don't teach it, and it's just ridiculous to trade during a market moving event like a jobs report. Same thing goes for FOMC announcement days. Okay, so let me continue for the day, and I'm going to show you why I used the Taylor trading zone. Now remember, nobody knows where the market is going to trade. Nobody knows where the market is going to trade, okay? Now I'm going to take you through the day, or at least part of the day, the first half. Most people don't trade the whole day because it's boring to watch the screen. Again, these are 3-minute candles. Okay, I'm going to stop it over here. This is about midday right over here at 12:30. Now, the Taylor calculator is particularly accurate as to the range that prices are going to trade for the day. And so you need to know how to use it. You need to have some experience. And if you've seen my previous videos, you know that it's important to know that you should transpose the calculator when you have some degree of where the intraday high or low is going to be in the first half hour to hour of the day. And so if we wait for a while, let's say till 10:30, right around over here, here is where we can see where the intraday high or low is within the first hour. Intraday high was right over here, and this is a 9:30 candle, and the intraday low at just before 10 o'clock, down at 59.57. And so we can take our Taylor calculator, transpose it to the intraday high, because we don't know what's going to happen after 12:30. We don't see that that it's going to go higher. And so where are we going to trade after 10:30? We can figure, well, maybe we shouldn't trade for the day. But I'm going to clone this, and I'm going to move it to the intraday high, to what was the intraday high, okay? Because by 10:30 we see that the market put in basically a double bottom, okay? So that's an indication that this was going to be the intraday high. So there are a couple of ways to think about this. Number one, knowing that the Taylor trading zone is relatively accurate, very accurate actually, we can see that the market traded down through the entire range of the day. And so if we take a trade at 10:30 right over here, we can say, well, wait a minute, the market already traded down through the entire range of the day, but it's only 10:30. What's going to happen the rest of the day? Well, look what happened the rest of the day, traded back up through the range. And if we take a trade at 10:30, conservative, because 10:30 is conservative. Why? Because you've waited an hour. You've waited an hour, and to see where the market traded in relation to the calculated trading range. And so the trading range was down here, transposed 59.59, and we take a trade around here, figuring the market is going to trade back up through the trading range, and sure enough it did. So you could take a trade down here somewhere and make yourself about 30 points. Very nice trade, very nice profit for the day, and be done with it. Again, nobody knows where the market is going to trade, but the trading zone is a pretty accurate indication of where it's likely to trade. And so that's the trade. So not every day is a great day to trade, but most days you can use the Taylor calculator to give you an indication of where the market is likely to trade. Okay, so that's my video for today. Thanks so much for watching. Trade safely. I'm Marv Eisen for Timeless Dollar Trading Academy. And if you'd like to know more information about the Taylor calculator, how it's calculated, how the formulas are, it's all on my website, timelessdollar.com. I don't hide anything. And go to timelessdollar.com. And on the navigation bar, click the link, Taylor Trading Calculator. Thanks again for watching. Trade safely, use lots of patience, and I'll see you in my next video.